Hello everyone, welcome back to another weekly review, and I'll be doing a little bit of a macro talk too about the current economic situation and what the risks are for me going forward this week. First of all, I want to just go over my trades. So I didn't trade at all this week, and obviously, like I said last week, there was a FOMC meeting on Wednesday. Very slow days ahead of Wednesday. There were only 2 losses, and I didn't take any of them. So I'm going to start with Monday, but to kind of show you what I'm talking about, when we have a Fed meeting and Jerome Powell is going to answer questions about monetary policy, a lot of things he could say that might make the market react a certain way, and so a lot of people just prefer to wait until that happens. And so you could kind of see how Monday, the whole morning at 9:30, we just were sideways. The only real movement came from Asia and London, which, for these people buying in Asia and London, they're maybe less influenced by what the Federal Reserve has to say, and there might just be more direction. But even then, there was still a lot of sideways price action. I feel like the buying happened, or price needed to go to, I don't know, it looked like it drew too close to this high but failed to go any higher, rejecting this daily gap. There was setups, but it eventually kind of gave in and went lower, just enough to kind of grab the low of 9:30. So this, if I toggle regular trading hours, it would be the low of the regular trading hours, but refused to go any lower than that. And until then, he just kind of chopped up and took multiple highs. I could have had multiple losses in this. I'm only logging this setup, but because this candle is kind of small, but I mean, these types of days where I'll probably blow my account if I try and trade it, because I'll take loss after loss, and whatnot. I did like the afternoon though. However, this is a nice kind of consecutive set of candles. We run up above it. If we had continued lower all the way down to the relative equal lows in the morning, I would have really liked that, but we didn't. I just want to see what the 1 minute chart looks like. I wouldn't have had an entry anyway. But moving forward, Tuesday was more of the same. Again, we had nice price action early in the morning. Kind of London seems like it. My model showed up. If I use a 15-minute chart, we had a nice sweep, and then that could have been seen to have. From there, we take it to go higher. Picks up around 8 a.m. And then right at 9:30, tops out and slows down again. Same thing as Monday. There's nothing to do in the 9:30. Everybody during New York, everyone at New York is waiting on the sidelines. Afternoon, again, there was a bit of a sweep to kind of clean up a lot of this consolidation, but nothing meaningful for me to take a trade. Again, we're Wednesday, ran up overnight, consolidated, and in the morning, it's like right before the morning, we had a huge drop. But in the morning, we really didn't do anything because we had FOMC. They kept it sideways again. It looked like maybe this was a run-up manipulation, not super clean. But when it started consolidating and making lower lows, I kind of gave that up. And then FOMC really didn't do much. That was surprising. It still moved, but you could see how usually when we have an FOMC that's really important, price will do something like it'll go all the way up here and it'll go all the way back down. And it's like crazy. It'll move so much in 1 second and make up the entire day's range in just a matter of minutes. However, this time it really didn't look like anything. It looked like a durable goods red folder news. And I think that's just because of how the Federal Reserve communicated at this meeting. I don't know if you watched it, but basically what they were saying is a whole lot of we don't know. With what's happening in the war, they have no idea how it's going to impact the economy, how bad it will be, how long it will be. And so there's just more of saying we'll wait and see. And right now it seems like they're just staying still. They're being very cautious about continuing to cut. And so people are starting to think that maybe we'll get less interest rate cuts than we should have this year. And some people were even asking Powell about raising rates. And I just think that the market doesn't want to overreact, because here's the thing: in the past few wars like Ukraine, Palestine, and all these different wars, the markets always, the headlines, sorry, have always overreacted, and the market's always underreacted and been like, well, these things are going to roll over. Why would this one be any different? So the way I see it is the markets, and what I've been showing in my past weekly reviews, they've been essentially pricing in a contained war, something that's not going to escalate too much and that's going to roll over after a few weeks. But on week 3, things are still escalating, maybe turning into a regional, well, definitely has already turned into regional conflict. But now Iran's threatening to attack water sanitation plants, any oil infrastructure belonging to the U.S. And this is very bad, because if they attack the water, people don't have the water to produce oil, and that's even worse than just destroying the oil, the energy infrastructure, because now it's like it has more so to do with, like, oh, they can't even drink now to survive, so they'll have to be evacuated or whatnot. Trump is sending more warships and Marines and Navy SEALs he's deploying them to the Middle East, and he did talk about on Thursday how, oh, we're talking about winding down operations, de-escalating, but Saturday night, he gave Iran an ultimatum of 48 hours to reopen the Strait of Hormuz, or they would go after its energy infrastructure. This would be very bad for the oil prices, I'm pretty sure. At the same time, also, the United States lifted sanctions on Iranian's oil. So Iran can sell the oil for a better price, and this is in aims to keep the oil price down. So this is why we might have seen a lot of equities sell off, like the Nasdaq, gold. I don't know if you looked at the chart of gold, yet oil stayed kind of stable around 100, which is manageable if it stays at 100. But if it goes higher to 150 or 120, we're kind of fucked. Anyways, continuing on, Thursday and Friday were really the days I wanted to focus on. If there wasn't going to be any movement for FOMC, because Thursday can always catch tailwinds from FOMC, but obviously there was no volatility. However, it just had news of its own. And so we did see a really nice sweep. I really like this candle, and right at 9:30 we opened up, we swept below it, and then we started displacing higher, and I was ready to take a trade. This would have been a really nice trade. However, I was looking at 2 gaps, mainly this one, and I had set my limit order right at 9:39. I set my limit order right here, and we didn't enter it. Now, in hindsight, I was like, oh, I could have gotten in right here and stuff, but this is just in hindsight. I would have still had a 4R. Actually, I wouldn't. I would have had a 4R only later in the day. I guess not. I wouldn't have even. Yeah, I would have taken all day to hit. But, I mean, it didn't give me my entry. It is what it is. Sometimes it just won't give me my entry. And I have to be okay with that. Anyways, but yeah, the setup was there. The infrastructure, the setup was there. It just didn't give me my entry. And it is what it is. Anyways, then Friday, you can check my Twitter about this one, but I was ready to take this setup. But I was kind of conflicted about it, because this is a 5-minute swing that was taken. I didn't end up taking this. What I said was, because I also saw at the same time, I was also seeing this sweep here. The reason why I wasn't considering this as a bearish sweep and it was going to go lower is because we're beneath midnight. But I know, however, sometimes when we're trending and we're beneath midnight already, and midnight's at the high of the day, not at equilibrium, but at the high of the day, I know that sometimes prices just ignore midnight and will offer really good setups and continue going lower. So I was very careful about taking this trade. I was very quickly going to go break even if it didn't go my way. And so this gap right here was formed, and I wanted to trade into a 942, but when it went higher, rejected off this higher time frame gap, so that there's maybe on the 15-minute chart, there's an order block. where are we? 9:30. Oh, yeah, order block right here on the 5 minute chart. There's a bigger fair value gap and a breaker. So this is like the 15 minute order block right here. We ran into that. So there was a lot of, and of course we've been very bearish through FOMC. Thursday kind of consolidated, failed to continue going higher, continuing to make lower lows. There's no evidence that, and we have relative equal lows too. There's no evidence that we're gonna go higher. If it had wanted to go higher, I don't think it would have given us this 9:30 candle. However, my trade was just gonna take profit at this high, so who knows? Maybe it'll come up to this high and then it won't do anything. But I wasn't really comfortable at first taking the trade, and after thinking about it some more, and you can see my Twitter, I said if it comes back to my entry, I wouldn't be taking this. So it was pretty much like I'll get in quickly. I'll think there'll be a pullback to a higher level, like the order block right over here, and then I'll put myself break even in case I'm wrong. Anyways, ended up not working. There was a really good setup though right here, for silver bullets. I would say from 9:45, not 10 o'clock. But this is if you're following a trend, if your bias is short, and then that too, and over here. I did think of taking this trade, and then this I didn't see it because I wasn't on the chart. But I didn't because it's not part of my rules. Anyways, we just didn't do anything the rest of the day. Just continued to pick up after lunch. Just went lower. Now, that's out of the way. I want to talk a bit more about the economic situation. So first, as you see, gold went down quite a lot, making lower lows. Really good buying opportunity, I would feel like, for me at least, just because of the price it's at. I mean, we haven't seen these prices since December 2025. It was only a few months ago. But yeah, silver and gold both took a hit. Bitcoin is kind of holding, to be honest. And this is, I think, kind of telling, because I feel like Bitcoin usually in the past is the first to kind of pull back. So the fact that Bitcoin's holding its lows but everything else is selling off, I don't know, something's fishy. I'm not saying we have a bottom, but I would just consider a lot of what's I guess happened in the past. With everything just rolling over, why would anything be any different? That could happen. But I think it could also. I think this is what the markets want to happen. So I'm not necessarily saying that Bitcoin's holding and then this is a low. I mean, the markets could be completely wrong, and this could escalate into something deeper. And then everything else continues to sell off. That's very possible. So, anyways, let me go into different indicators that kind of show a bit more alarming things. So the move index actually made a very big move this week, and this is just signaling that there's volatility in the bond market. So a lot of people are selling bonds, and you could see that being reflected in the 10-year. This is the bond prices are up. No, the 10-year yields. The yields are up. I don't know why 10 years also up. It should be down. If I go to ZN futures, it should be down. Yeah, okay. So the 10-year prices are down. You can see how fast they've been going down the past few days. This resembles something like we did in 2024 around September. And I'm pretty sure this was when, if I'm not mistaken, Israel and Gaza, either Israel and Gaza, I'm pretty sure Israel and Gaza got really bad. So I think people are kind of reacting the same way. I don't think we're done reacting like that. Like, there's still going to be a bit more to this war before everything gets solved. The VIX is calm. It kind of calmed down a little bit, but the bonds are usually the first thing to go whenever there's stress, or whenever something big is about to happen, like a crash. Credit yields are still low, so there's nothing right now indicating, the markets are not indicating that we're in a stressful period. Back in 2020, even in the war 2024 with Israel and stuff, the markets didn't price that in like it's really bad. During tariffs in 2025, they did, and then by April, when everything rolled over and people came to agreements, kind of everything calmed down. But when we get to around 4%, that's when you should start worrying. Like, okay, there's stress in the system. People are really worried, and we're not there. I think it's more like 5-6%, but we're not close yet. I mean, we're getting a little bit more premium, but we're not there yet. So I wouldn't worry too much about credit spreads. The only thing I'd worry about is just the war continuing to escalate. I mean, again, there's communications from Trump and the Pentagon trying to calm markets down. The narrative being painted on the market is saying a complete different thing, and the market is just on both sides. Narrative on the news is saying a completely different thing. The market's just on both sides. So, anyways, before I end this off, I want to talk about something that I've been studying for a long time. But I asked Chad a few sets of questions. First, I asked, is it true that the Fed are targeting an average inflation rate of 2% over time? And they did talk about this in a speech a long time ago, and Chad said it was true, but not exactly how the Fed frames it anymore. I think Chad is pretty much, I'm not saying it's wrong, but you'll get into what we end up agreeing in the end. So we have a little bit of a debate. But it essentially said that, yeah, for 4 years, 2020-24 era, they wanted inflation to average 2% over time, not hit exactly 2%. So if inflation was below 2% for years, which it was, if we look at inflation and we draw a line over 2%, you can see how from 2012 we were completely beneath 2%, so this entire area here, until COVID. Now, the problem here was in 2020 we had historically low inflation. I don't know if it's historically low, but we had very low inflation, 0.3%, right before COVID. The interest rates were very low, as you can see. They've been low, from 2012. The Federal Reserve expected inflation to go back to 2% and start rising as they cut the rates, and by 2016, 2017, you see how they kind of stopped cutting? Nothing happened. Inflation wasn't picking up, so they continued to drop the rates some more, and still at around, this is unemployment. Oops, my bad. I was confused. I'm like, no, sorry, this is better. Yeah, so around 2017, they had dropped the rates from 2000, after the financial crisis. They dropped the rates in 2009. They were low in 2016, 2017, when they expected inflation to pick up again. It didn't. There was, I think, a little crisis that made them have to raise the rates, and then inflation wasn't picking up, and they just dropped it again to kind of get inflation to pick up. And for a few months it was at zero until COVID happened, and then they had to raise the rates once a bunch of stimulus came into the economy, then pushing inflation higher. So without COVID, I don't think they would have been able to push the rates higher, and I don't think they'd be this high. I think they'd be more around this lower area beneath 2.5%. And inflation stuck. Now, why inflation was stuck like that? It has to do with the age of people, demographics, like how old people got, immigrants working at lower wages, and less interest in innovation, and big corporations buying like stuff like AI. I guess also maybe there has to do with globalization and de-dollarization. But whatever the case was, point is that we had an unnatural phenomenon where the unemployment rate was historically low, inflation was very low, and the interest rates were also very low. And yet, usually low interest rates, high unemployment should create high inflation, because everyone's employed, everyone has money to buy goods and services, and businesses are running and getting investments to hire more people, making the unemployment low. But it wasn't doing that. And this is something Bernanke in 2002 and 2009 talked about in many speeches. He warned that this could happen and this might be a problem. And there were speeches made in 2017 or 19 and 2021 by Powell and another guy called Williams, One of the most notable speeches was surviving in a low neutral interest rate world, or monetary policy in a low neutral interest rate world, something like that, where they just talked about how the neutral interest rate was very low. The neutral interest rate, or called R star, is a rate at which the economy is neither being stimulated or restrictive, and this is kind of like neutral, where the economy is just not shrinking or growing. When the interest rates, nominal rates, so is the Federal Reserve's interest rates that they set, when it's below this rate, the economy is being stimulated, and when it's above it, it's being restricted. The gap that widens and shrinks is the monetary policy, but the neutral interest rate can move on its own without the rates actually moving. But I'm getting ahead of myself here. Let me continue this. The chat says what they target now is price stability as 2% inflation over time, but in practice it's more like we aim for 2% going forward. Not we owe the market higher inflation because we undershot before. It was like that, but not anymore. What matters for them, blah, 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 doesn't matter. So anyways, I said, but I'm sure they want it to move to 2% as slow as possible. So you're not crazy for thinking that, but it's not exactly their objective. It's more of a constraint-driven outcome. So here, I'm saying that their intention is to get it to 2% as slow as possible. Chat is changing that and is saying it's not their intention. It's just the outcome has to be like that. They're constraint driven. And constraint means that you're just stuck doing something. So the Federal Reserve has no choice to see it go to 2% slowly. However, I believe that they're saying they want to go to 2% because they're communicating as fast as possible, because they're communicating that to the market to calm them down, and so that they can focus on unemployment mandates, so they can stop lowering rates. They say, oh, we've done enough progress on inflation, it's coming down to 2%. We're comfortable with what it's going. We're not going to keep rates high so we don't affect the unemployment situation, and we can keep unemployment stable. But in reality, is it gonna go tomorrow to 2%? No, it's gonna happen very slowly, and it's not because the Federal Reserve necessarily wants it that way. It's just because they have no choice to see it that way. So again, this when chat says what they actually want, it's just what the communication is. But everyone understands that communication is one of the best tools the Federal Reserve has, better than quantitative easing or rate cuts. So yeah. Demand is collapsing, credit conditions are tightening, unemployment is about to rise. That's basically you killed inflation, but you also killed the economy. So they prefer a controlled glide down, not a crash. The real trade-off, too fast, inflation down, recession risk, liquidity shock, market crashes. Too slow, inflation persists, credibility risk, higher rates longer. So it's not slow as possible, it's as fast as we can without triggering systematic stress. Why markets are confused right now. This is where your intuition is sharp. The Fed says we want 2%, but their actions sometimes look like we're okay with 3% for longer. It creates the feeling of they're dragging it out on purpose. In reality, they're trying to avoid a hard landing, but that automatically results in a slower disinflation path. Right, so my wording is wrong. Anyways, then I said maybe they communicate they don't want that so people don't panic, but when shocks like pandemic, tariffs, or energy occur, they have no choice to see inflation higher for longer, which helps raise the neutral rate. This is basically what I said, what chat said, but I'm adding more specific context. Then it said you're circling a real dynamic, but intent versus constraint, basically what chat was saying, matters a lot here. The Federal Reserve absolutely manages expectations. They don't say we're okay with higher inflation for longer, because that would unanchor inflation expectations, push yields higher immediately, and make their jobs harder. So yes, their messaging is intentionally stabilizing, not fully expressive of every trade-off they're making. But here's where your idea needs refinement. You said that shocks force inflation higher, which helped raise the neutral interest rate. That can happen, but it's not something they're trying to engineer. It basically has to do with credibility and bad inflation, where there's a weak demand, growth goes down, but prices go up. So people end up paying more without actually growing the economy. They don't benefit from that. It actually reduces their control. However, I disagree with this, and you'll see why. The neutral rate is important here. It rises when the economy can sustain higher rates. This is very important. Productivity, demand, and fiscal spending are strong. It does not reliably rise just because inflation spikes. But inflation being higher for longer can raise the neutral interest rate, and chat will agree with this. If inflation comes from supply shocks, R star might not rise at all. The Fed might just be forced to keep rates high relative to a weak economy. What actually happened recently is post-pandemic, there was massive fiscal and demand push R star higher. Supply shocks pushed inflation higher. The Fed got higher inflation plus potentially higher R star. So it looks like inflation helped raise neutral, but both were driven by deeper forces, fiscal, supply chains, geopolitics. But however, having inflation high allows them to keep their nominal rates high, which and the inflation rising is kind of what's stimulating the economy. But there's a reason why this gives them more control, and you'll see why next. But you're picking up on something real. When shocks hit, the Fed often has to accept inflation staying elevated for longer. So in practice, constraints leads to forced tolerance of higher inflation. But it's not the same as intentionally using inflation to reshape the rate regime. Um, However, I said I'm not saying they are using it as a tool. I'm saying that's what happens when shocks occur. I said, yeah, when shocks hit, what does the Fed end up doing, even if it's not their intention? This doesn't really matter too much, but pretty much they're just picking bad choices. What actually happens, because they can't shock the system too hard, inflation stays elevated for longer than ideal, rates stay higher for longer, financial conditions remain tight over time. So even though they didn't choose it, that system drifts into a higher rate, stickier inflation regime. The neutral interest rate can end up looking higher because inflation persistence forces policy rates up, and this is exactly where inflation allows the rates to go up, which rises the neutral rates because the economy adapts to higher interest rates. Markets reprice what normal rates are. Fiscal and structural forces may reinforce it. It's not clean R star rising from strength. It's more like the floor of rates getting pulled up by constraints, by shocks, by fiscal spending, by geopolitics. Anyways, shocks force the Fed into a situation where inflation stays higher for longer, which indirectly keeps rates higher and shifts the whole regime upward. Now, here's where I say this is the part about how I think that it does give them more control, or at least more power. So they could still be targeting an average inflation rate. Oh, sorry, no, not this one. We'll move to the next one. Could the elevated R star or neutral interest rate help them have more effect when cutting rates by being able to cut more before 0%? Now, let me take you back to when we had inflation near zero, when we had interest rates or unemployment rate near zero, and interest rates near zero. Right? This essentially, if something happens like a war, like with Iran, the Federal Reserve, if they cut, they go into negative. Now that's very bad because having a negative rate essentially means that you get paid for taking a loan. So basically selling dollars and owing dollars, you get paid. But if you need dollars and you buy dollars, like other countries do need dollars, like Japan holds $13 trillion in bonds, they do a lot of trade with the United States, they can't afford to have a dollar shortage. But so they have lots of bonds that pays them. If, however, the rates are negative, they have to pay the United States for owning dollars. The dollar would devalue very quickly. A lot of people would the attempts to de-dollarize, I'm not saying they'd be successful, but the attempts to de-dollarize would happen even faster. And de-dollarization that might have happened over 30 years could happen over 10. So this wouldn't be good for the United States. And just like Japan, they were in negative interest rates, and it's because they spent way too much. Just like the United States, they spent way too much. And they're still stuck in it now for years. I mean, it's a trap pretty much that, it's really hard to attract investments when you have negative rates. What Japan did when they got into negative rates, even worse, people started selling yen, and then they went over and used the yen to buy dollars. So it just pulled more capital into the United States dollar. So yeah, this isn't really a good thing. If I don't, I haven't confirmed this, but I don't think this sounds like a good thing. If I'm a country and I don't know if I want to hold something that I have to pay for, unless I really need it. And I'm not saying people will stop buying dollars right away. They're still going to keep buying dollars, but de-dollarization attempts, the forces behind that, are going to happen even more. So anyways, back to my point, where now, because of the higher interest rates in the economy, the rising R star, sustained higher inflation and higher rates, increasing the level of R star, it allows the Federal Reserve to stimulate the economy Instead of cutting below 0% to stimulate, now they only have to cut below, right now it's around 3 to 3.5%, so they only have to cut below 3% to stimulate the economy. You see how much of a difference that is? If they need to respond to a war or a crisis, they can cut beneath 3%, and they have as many cuts as they want before they get to zero. Well, not as many cuts. I mean, they have a lot of cuts before they get to zero. Compared to if the R star was at 0.25%, they can't really cut beneath the R star before getting to negative territory. And so I think this is where they become more powerful. They get more ammunition. They have more control over monetary policy by being able to cut rates, and having rate cuts are more powerful. So basically we'll say, yes, this is a solid insight and you're thinking in the right direction. Short answer, yes, a higher neutral interest rate does give the Federal Reserve more room to cut before hitting 0%, which makes rate cuts more powerful. Why the R star helps policy effectiveness. Old world, R star was 0 to 1%, Fed funds peak at 2 to 3%, cuts hit 0 quickly, limited room. Higher R star would mean 2 to 3%, hypothetically, because again, you can only calculate it. Right now it's around, people calculate to be 3 to 3.5%. Fed funds peaks at 5 to 6%, now they can cut hundreds of basis points before zero. That means more ammunition using normal rate cuts, no need for emergency tools right away. Why that makes cuts more impactful, I'm pretty sure everybody, higher starting point, stronger transmission when easing. But here's the catch. When they do start cutting, the economy might not need as much help, or stress might already be building elsewhere, credit, liquidity, and it is. I mean, there's so much stress in the credit market, and we're seeing liquidity being pulled from the market right now due to a number of reasons happening around the world. So there are trade-offs, obviously. The deeper dynamic, this ties to your macro thinking. The higher R star regime, tightening phase feels longer and heavier. Easing phase can be more aggressive initially, but may not instantly fix underlying issues. You often get late, fast cuts, but into a system already under stress. That's exactly what we've seen. What this means for markets. If the R star is truly higher, the Fed can stay tight longer, then cut hard when needed. That creates setups where markets grind under pressure, then suddenly violent reversals when cuts begin. So, if you want to go one level deeper, the real question is, are we in a high R because of strength regime or high rates because of constraint regime? So yeah, my point is, all this is, I see a lot of people saying that Trump is an idiot, the United States is an idiot, they're going to war with people they don't need to. But however, the whole time, from COVID, from Trump being elected, from tariffs, from all these different wars that's happened, all that's done is create higher inflation fears, which helps the Federal Reserve keep rates higher. Now, I don't think they're idiots. Again, I'm not saying everything was planned and it was communicated between them and, they were like, okay, we're going to do this war at this date. No one did that. What I do think, though, is that the Federal Reserve knew that for the United States to avoid de-dollarization, they needed to go to war with people. They would have needed to start wars soon. They knew that Trump may get reelected potentially, and that would cause higher inflation expectations. And maybe even they knew about COVID. I mean, there was a breakout and people were warned. I'm not saying the breakout was intentional and it happened for a reason, but people were warned ahead of time. And so, I mean, but I'm sure, and this is actually, I heard of, I don't know if it's true, but I've heard of reports, documents that talk about the war with Iran and Venezuela and the whole military strategy that were released after these things happened. And I mean, I don't think it's crazy to say that for the last 10, 15 years, the United States had always planned to take out Maduro and Venezuela, had always planned to, go to war with Iran, take Greenland. And far before Trump, I don't think this is Trump's idea at all. When the Republican Party came into power, I believe that they had duties and roles to fill. And I don't see Biden doing these things. I think Trump is just representing someone of strength, someone who's strong, and people think that this is because of him, but I don't think it's him at all. I think he's just filling a duty that, he's being told to do by a system, by not by one person, but a system of companies, and countries, and just like, that's just how money works. If you didn't know, but 80 to 90% of what a political party will do during a president campaign is influenced by money, not by voter choice. Actually, let me just verify this right now. Um, what what percentage of what a political what the goals of oh my god political science, especially studies in U.S. policy influence, tends to show voters, especially average voters, strong influence on broad direction like lower taxes, more jobs, weak influence on specific policy details. Donors, economic elites, much stronger influence on specific policies, regulations, and timing, especially powerful on complex or low visibility issues. Average voters had little independent impact on policy outcomes. Economic elites and organized groups had substantial influence. A realistic breakdown, this isn't exact, but a useful mental mode. 50 to 70% of voters set the narrative and priorities, what wins elections. 20 to 40% donors interest groups shape how policies are designed, what actually gets implemented. 10 to 20% party elites, institutions, internal strategy, ideology, constraints. So, why donors punch above their weights? Donors influence more than their share because they fund campaigns, provide policy expertise, lobby continuously, not just during elections. Meanwhile, voters are broad but inconsistent. Donors are focused and persistent. The key distinction is donors usually don't override voters completely. Instead, they operate within what the voters will tolerate. Now, when it comes to the last 10 to 20%, internal strategy, ideology, constraints, when it comes to war and everything, these aren't things that people knew about. But I think that obviously there are institutions that's showed the United States that we need to go to war. I mean, it's if think about AI and everything that's gonna change in the world in the next 10 years. Imagine if the whole economy runs on AI, how dangerous it would be for the United States to not have control over energy. What if this war with Iran would have happened 10 years down the line? And all of a sudden energy had a much more impact on the economy, because what if our economy is run by I mean, what if, like, when you buy something at a store and AI is there to help you, or the economy is run by AI or whatnot? Like, you can't reliably rely on oil all the time unless you have ways to control it and to make sure that it won't be interrupted. Then I mean, yeah. But also with de-dollarization, this is just another way for the United States to have access to more oil supply and control over oil supply to be sold in dollars. So dollars influence spikes when issues are complex, like financial regulations, energy markets, tax structures. Public attention is low. Both parties are somewhat aligned already. So yeah, and this plays a role like fiscal policy. Donor influence plays a role in fiscal policy, energy pricing structures, and even how aggressive governments are with inflation. And yeah, I mean, it's not crazy what I'm saying, but I'm not saying the presidents are puppets. I'm just saying that there's a lot less they can. There's a lot of things that I'm pretty sure they have to do that people aren't just aware about. Like, they have a duty and responsibility to the party, which gets money from institutions to do those things. Yeah. Anyways, that's it for today.